Hello traders, Gary Wagner here just before 11 o'clock in Honolulu, 5 o'clock in New York on Monday, the 7th day of July, 2014, and this is the Daily Report for Gold and Silver. Hopefully all from the United States had a great three-day weekend as the markets were closed. As we have opened again this Monday, we have slightly lower pricing in gold, currently trading $13.1959, puts it off roughly $1 on the day. Now the low $13.1060, the high $13.2080, and as I said, current print is $13.19, call it 6. Silver is trading lower this morning, off roughly 13 cents on the day, 21.20. As you can see, that's our current print. Now it's 21.09. The low on the day is 20.73 according to Kitco, although we're showing a low that is a little bit above that. We'll look at that as we talk about silver towards the end of the show. And 20.73 on the low, 21.16 on the high, current print 21.08. And as I said, more on silver towards the end of the show. There's no doubt, after a three-day weekend in the market, the traders have voted and they are supporting currently the price of gold. As I said, we're only off roughly about $1 on the day. The low was $13.10 and change. Of course, our stop is below $13.11. We didn't have any trouble getting hit on that. For those that are still in the trade long at $13.03, those that got out of the trade at the top where we suggested putting a price order in roughly at around $13.30, I suggest that you wait right now because there is the potential for some sort of corrective action in gold. When we consider the fact that the market started roughly at $12.40, comes up to about $12.80, we get a perfect 61% retracement here, and now the market is really spiked, and it spiked dramatically in terms of the percentage that it has moved from this move here. We would want to run a fib extension. Let's go ahead and put that in. Once we put the fib extension in, I think you'll find that our results are quite interesting, and it really lends itself to the power of these fib numbers and how well they are in terms of predicting basic natural patterns within the market. So let's take a look at what we've done here. We've put an extension in, and the extension itself goes from a starting point and an ending point, so the entire rally. We then fix that point, the extensions, to start after that 61% correction. So 1257 becomes our zero mark. 100% extension, meaning if this particular rally and this rally were equal, it would have stalled at around 1300, 123, 138. But notice this, 161% extension, which is traditionally a classic extension. If this was, let's say, on an Elliott wave count, this would be wave 1, this would be wave 2 here, this would be wave 3 here. You would get a typical extension on that market of about 161. You could get that. And so when we look at this and we consider the fact that the market genuinely has moved up 161%, that could be the top before we see some sort of corrective action. Now, if that is the case, where can we plot it to go? Well, then we would run of course, a basic fib retracement for just this last rally. But what we're finding interesting is that it did stall just above the 161% extension, but it's also found supported 1311. 1311 is a number that keeps coming in. Now that's 123% extension of this rally, but realize that especially with Fibonacci numbers, they tend to all kind of match together because of the nature of the pattern itself. And the pattern itself, when you view it as a whole, all of these components will fit together like a puzzle. So the fact that we've got a fib number here that's 1311 doesn't really surprise me. It would more surprise me if the market found support or resistance at a point that really didn't match anything. We did get that as we saw this market retrace. We got just over a 61, shy of a 76% retracement. But for the time being, we can absolutely see where we would have supportive action in here, and that's why our stop is there. We also currently are pegging our resistance at this high, which is roughly at 1330. So that's kind of matching up also. So traders, have gone ahead and I've pulled up a daily chart, Japanese average format, the Henkin Ashi chart itself. And what we're noticing on this is another day of red, meaning we're seeing this particular market having some downside pressure. However, when we consider the strength of the trend, and that's what these candles are great for, you've got really, really small bodies. You're always going to, or typically I should say, going to get that as a pivotal candle right before the break. You'll get these pivotal candles right in here. And the pivotal candles, of course, are smaller body candles just before the market actually goes and breaks. We got the pivotal candle, but you'll typically get after that pivotal candle, you'll get some strength in the market. So in here you see it's kind of growing in strength here. We're also having this waning in strength here. So you can see the market unfold in that way, but typically you'll get a large, especially on the downside in a retracement, you'll typically get the market moving in a corrective manner with a pretty long candle. You get that pretty much in any of these major breaks, and so we're not seeing that. And so because of that, you can, of course, maintain your stops. You could look to pull profits also. You're in at 1303, you're out at 1319. It's still a good trade. We had a great trade on our last trade, so it keeps it going. If you get out, of course, just below 11, you're still taking profits, but not the kind of profits for those that have taken out at 1330. Now, there is no right or wrong answer, and there is no wrong profit in the market as far as I'm concerned, whether you take $10 or $100, per ounce on a contract. Of course you want the $100, but making a profit to me is what's always critical in the market. The percentage is something I always look to increase, but the key is always maintaining profitable trades. So either way, any way that you play this at this point, it's going to be profits for you. It's just a matter of maximizing those profits. And to give us a better indication of the market, let's make sure that all of this data has been updated accurately, and what we're looking at in terms of the candles are true candles. There we go. The one thing that we can say is that we're looking at a scenario. Remember this scenario here in which we trade within this really defined range. Well, again, we hit this top. We then made another top, so we've got real resistance here. But in terms of a support band, again, that 1311 looks pretty strong. Now, does that mean that the market is or is not going to break? Well, that's to be determined. And as you can see, trading on the day now is in essence up a little bit, but still unchanged. We are getting that doji candle. We are seeing good support here. So it is a tricky call whether to stay in or exit with profits. My sense is always I'm going to let something run. The last couple of trades, obviously the correct decision, or the more profitable, I should say, decision, was to get out on my price order, but we never know what the future is going to bring. So act with your own senses. What I am here to do is to provide options and alternatives to you, strategies to you, so that you can take your knowledge, your information, and how you perceive the market and make the best out of the situation. In other words, maximize profits on this particular trade. So traders, we are looking at our daily chart in silver. We're already starting another session right now. This is the session that we've just had. Our stop's currently just below 2080. As you can see, the market has come to it, but not really below that particular price point. Traders, you should also be long this particular trade. My current suggestion, maintain your long positions in gold and silver. Maintain your current stop placement. This has been Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow on Tuesday for another daily update review. Bye-bye.